Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and energy today. And if this is the first time listening, welcome to the podcast. And on today's episode, I wanted to do one more episode, hopefully one final episode on student loans. There have been a substantial number of changes happening over the last couple of years. And as I look back and listen back to some of my podcasts on student loans from the last year or so, a lot of it's become outdated already. And I'm still getting quite a bit of student loan consultations, still getting quite a bit of questions about what to do as payments are restarting soon. And these questions are coming across the board. The questions are coming from recent graduates. Questions are coming from those who've been practicing for a little while, those who own practices, husband and wife teams who both have substantial student debt and both own the practice, and those who have been paying on their loans for quite a while, wondering what to make of some of these changes. So the student loan questions have been coming across the board, different types of optometrists in different settings. So I wanted to do one last student loan podcast before moving on to other topics and revisit some of the recent changes that have come up over the last several months, talk about some important deadlines that optometrists need to know about related to your student debt, and finally talk about what are the different approaches you should think about taking in tackling your student loans and what are the factors you need to consider when making that decision. So with that, let's go ahead and dive in. And this is going to be a pretty meaty episode, so go ahead and skip and bounce around to the parts that are most applicable or helpful to you. So let's start with some updates. And over the last several months, thinking back to around the 4th of July, the Supreme Court ruled against the Biden administration and its $10,000 to $20,000 federal loan forgiveness. That was something that people have been waiting on for quite a while. Almost immediately after that, we saw something we've definitely been waiting for a while, which is the final rules for the new SAVE income driven repayment plan. And this is a big one. And this is a rebranding of the current revised pay-as-you-earn plan. And they've changed it in a few important ways. Number one is that it's going to have a more favorable payment calculation. If you think about how income-driven repayment plans, their payments are calculated, it starts with your income. So by default, it's your adjusted gross income on the tax return. So it starts with your income. It subtracts out an amount for the federal poverty line based on your family size. And then it multiplies whatever that result is by a percentage. So it starts with your income, subtracts out a certain amount for the poverty line amount based on your family size, and then multiplies that by a percentage. And that is your annual payment. And so they've tweaked both of those different parts of that equation to make it more favorable. They've increased the poverty line amount that subtracted or shields your income from the calculation. And they've slightly modified for optometrists the percentage that they multiply that by in order to get your annual income. So they've improved that payment calculation. They've eliminated unpaid interest accrual, which this is a really important, interesting one. What can happen on income-driven plans is that if your calculated loan payment based on your income and family size is less than the amount of interest that's being charged on your debt in that year, that unpaid interest will accumulate on the side. Remember, federal loans use simple interest. They work on simple interest, not compounding interest, which means that the unpaid interest accrues on the side. It's not yet added to principal. So in those certain cases, that unpaid interest can accrue on the side, and the SAVE plan removes that unpaid interest, which makes it a really interesting option if you're using income-driven plans temporarily, and that there's not going to be that additional interest piling up. You're just going to be seeing that principal amount. And then the third thing that's new about the SAVE plan compared to the revised pay-as-you-earn plan, repay, is that you can now file taxes separately and exclude your spouse's income from your payment calculation. Under revised pay-as-you-earn, you couldn't do that. Revised pay-as-you-earn already had the most favorable interest subsidy of the different plans, but you couldn't file taxes separately. Now you can under the SAVE plan. Now, there's a little bit of a caveat here in that if you are filing taxes separately, and that makes sense from both a student loan standpoint and a tax standpoint, if you're excluding your spouse's income from that loan calculation, you also have to exclude them from your family size under that poverty line amount. Meaning that if you're going to exclude them to lower your loan payment, you cannot also include them in that poverty line amount to lower your loan payment even more. Under the other income-driven plans, you could do that. Under IBR, under pay-as-you-earn, you were able to do that, but that's been changed under these new rules. There's a timeline in which this is going to be implemented. So if you're already on revised pay-as-you-earn, you're just going to see this automatically change into SAVE, and you're going to see the new features just be incorporated automatically. Officially, the full SAVE plan is going to be available in all of its glory next July 2024. However, at the end of July of this year, certain parts of the new plan will be live. So the higher amount of the poverty line deduction, that 225% of the poverty line deduction, that's available already. No accruing unpaid interest, that's live as of July, at the end of July, and then the ability to file taxes separately. So those are sort of the meat and potatoes of that new plan, and those are already going to be available once payments are restarting. There are also some future plan changes and limitations, and it seems like the government is wanting this plan to become sort of the one plan to rule them all. So pretty soon you're going to have a limited or no access to certain already existing income-driven repayment plans. So the first one is that as of July 1st of 2024, if you're eligible for pay-as-you-earn, which means that you were a new borrower, you had no federal student loans until after the fall of 2007. That's essentially the basics for how to qualify for that. If you are eligible for pay-as-you-earn, after July 1st of 2024, you're no longer going to have access to pay unless you are currently on that plan already. So if you're on the plan, they're not going to kick you off of it. But if you're not, after that date, you cannot get onto the plan. And any new borrowers are not going to be able to get onto that plan in the future. And there's going to be restrictions on the new income-based repayment plan as well. And that's not something we talk about a whole lot because it is almost identical to pay-as-you-earn. And you would be eligible for new IBR if you were a new borrower. So you took your first federal loans after, I believe, October of 2014. So you will lose access to this new IBR plan after you make 5 years of payments under the SAVE plan. So once you've made 5 years of payments, you're essentially committed to the SAVE plan. You're not going to be able to hop onto the other plan. But you've got some time before you need to make a decision there. So that's a restriction that's coming up over the next year. Another thing that's new is that there's changes to PSLF. There's a pretty good list of adjustments to the Public Service Loan Forgiveness Program. But one of the biggest ones and one of the most important ones are that as of July 1st of this year, doctors at Kaiser Permanente in California and other similar employers in California and Texas and other states are now eligible for PSLF, or they were not before. Because in certain states, due to state law, those doctors, those optometrists were not able to be employed directly by the nonprofit. They had to be employed by this separate for-profit arm, which made them ineligible for PSLF. And in a lot of cases, those optometrists and other physicians, doctors, ended up refinancing and exiting the federal student loan system. Well, as of July 1st, you are now eligible for PSLF, including prior work history. Now, it's important to keep in mind that your for-profit direct employer is not eligible, but you are now grouped under the nonprofit that is essentially the parent company of all this, right? So when filling out the PSLF paperwork, you do need to use the nonprofit information as you're filling that out. But that's a pretty substantial benefit for those that do qualify. And it was a major reason that sort of leading up to the recent deadline, optometrists were requesting refunds of payments made on their federal loans during COVID because they're now eligible for that PSLF program. So that is huge news for those that qualify for that in the states that restrict your employment there. So there's been quite a lot, and we're still learning about these changes and nuances to all these updates as we go. One example of that is that, as we talked about, if you're filing taxes married, filing separately and excluding your spouse's income from that calculation, you can't include them in the family size when you're calculating the poverty line subtraction, the poverty line amount that you shield your income from. So, however, what we found is that when you look at the income-driven repayment request form that you use to request to hop onto one of these plans, if you choose not to auto recertify your income each year, or if you choose to use an alternative documentation of income like pay stubs or something like that, your family size will include your spouse under the pay-as-you-earn plan and under IBR, income-based repayment. So this is a weird, strange nuance that you don't really know until you start to go through this and see what happens. So we're still learning as we go with a lot of this, and the services are likely going to be overwhelmed for a while. So have some patience as you're trying to get things sorted out. The wait times are probably going to be huge, and it's probably going to take a while for things to get processed. So just have some patience there. Keep at it. Keep getting the answers you need, and keep moving forward. So those are some of the changes that have happened over the last several months there. Now let's talk about some important deadlines that optometrists need to keep in mind. The first important deadline is something that is passed already, but that was September 1st. And that is the date that daily interest starts accruing again. So you may see that accruing as you log into your servicer. October 1st is the next deadline you need to keep in mind, and that is when loan payments actually start again. I've seen on some student loan files October 15th, but in October, we can be sure that your payments are going to start again. So hopefully you're preparing for that in your cash flow. For some of you, you may not have made payments for 3 years. Some of you have never made payments before. Maybe you've graduated within the COVID pause and you're just starting to sort this out. So October is when that's going to be starting again. Make sure that if you want your payments to automatically be debited from your bank account, that you're logging in and you're making sure that your contact information is up to date. Do that with studentloan.gov as well. Go to studentaid.gov and make sure that your contact information is up to date. And then make sure with your servicer that your auto debit is active if you want that to happen automatically. And you should already see when you log in your payment amount and due date. And you probably have received notification maybe by email from the servicer, but October is when payments start again. And keep in mind that there is a sort of 12-month on-ramp period for federal loan payments. So from October 1st of this year through September 30th of 2024, there's this sort of on-ramp sort of informal forbearance where if you miss a payment or don't make a payment, you're not going to be considered delinquent or reported to credit bureaus or placed in defaults or debt collection. So it's sort of they're considering it sort of a freebie over the next 12 months. And this might be something that you use strategically. For example, and this is a fringe case where maybe if you refinance your federal loans during the pause and then realize that, okay, that maybe that wasn't the best decision. Maybe you should have gone for forgiveness or PSLF using an income-driven plan. And then you've asked for a refund of that entire refinance balance, which I've seen happen and be successful. So maybe you have a situation where that's still being processed, and now you have a federal student loan balance that's been restated, and potentially, I'm not sure if this is going to happen, but potentially you're seeing where you might have 2 loan balances that are going to require payments. So maybe you use this sort of informal forbearance on the federal debt side as this sort of gets sorted out. That's just sort of an example I'm making up on the fly here. Or maybe your income is expected to be substantially lower and you're on an income-driven plan and you want to wait on the payments. So think about and consider carefully whether that's something that could be useful for you. Now, those months that you don't make payments are not going to be counted towards forgiveness, and it's probably still going to accrue interest, but it's something that you may find useful there. The next deadline is December 31st of 2023. And this is the deadline to consolidate your loans in order to take advantage of the income-driven repayment waiver or the IDR account adjustment. And what that is that if you think about all these forgiveness programs, historically, there have been a lot of ways to accidentally miss or lose credit towards forgiveness for the months that you were in repayment. You could have had the wrong payment plan type. So maybe you had direct loans or maybe you had FFEL loans instead of direct loans. Maybe you were in the wrong payment plan. Maybe you were in forbearance because your servicer said that was the way to go, but maybe it shouldn't have been. Or maybe you consolidated and that had wiped away all of that payment history, which is possible, actually. That's not uncommon. So there were a lot of ways to accidentally stumble and not get the credit that you should have gotten towards these forgiveness programs. So what's happening right now and through the end of the year is there is this pretty broad one-time account adjustment where the Department of Ed is going to look at your account and adjust your payment account, your payment count for a really broad list of reasons. They're going to give you credit for any months in repayment status, regardless of whether you made the payments or the amounts of payment you made or the loan type or repayment plan. They're going to give you credit towards forbearance if you were in forbearance for 12 months consecutively, or if you had more than 36 months, or if you had 36 months or more in total forbearance over that time period. They're going to give you credit for all of that, where forbearance typically didn't count towards that. Any month spent in certain types of deferments. And they're also going to give you, and this is a big one, they're also going to give you credit for all of those reasons for any time before a consolidation. So in the past where that would have wiped away all of that payment history, they're going to give you credit for all that. So that's something that's happening now through probably early next year. But December 31st is an important deadline because if you need to consolidate, you need to have it consolidated before December 31st in order for those consolidated loans to be factored into this account adjustment. And this is important for a couple reasons. Number one, if you're going for PSLF and you had FFEL loans, they're also going to give you credit towards PSLF, but you have to consolidate those FFEL loans into direct loans before the end of the year, before being able to get that credit. What you also find if you look through the website is that if you have a single consolidated FFEL loans, which could have happened if you consolidated them in the past, if you have a single consolidated loan that's FFEL loan, you can reconsolidate that single loan only for the purposes of PSLF. So that's an interesting little nuance there. Also, what's very interesting is that if you have overlapping loan periods where one loan or a few loans have a much longer payment history than some of the other loans, or you have some loans that don't overlap for some reason, they're going to give you the same amount of credit as the loan with the longest payment history, which is pretty substantial. So if you've been paying down on your debt for quite a while, or you've done some of those things that triggered missed time towards PSLF or long-term forgiveness, take a look at this program and take action on it, any action that you need to do before December 31st. The next deadline is March 1st of 2024. And this is the first date, this is the earliest that you would be required to recertify your income. And if your expected recertification date is before March 1st of next year, it's going to be delayed for 12 months. It's going to be pushed out 12 months. So for example, if your expected recertification date is January of 2024, it's going to be pushed out 12 months to January of 2025. On the other hand, if your expected recertification date is March 2nd of 2024, your next date that you need to re-show your income to recalculate your income-driven repayments is going to be March 2nd of next year. So this brings up some careful thought here in terms of what to do with your income on an income-driven plan, because your current income-driven repayment plan, when payments are going to restart, are going to be based on whatever they were before the COVID freeze on March of 2020. So you very well may have payments based on much lower income from 2019 or 2020 or 2021, maybe even 2018, depending on your recertification date. Or maybe you graduated during the COVID pause and you had very low income that you based your income-driven plan payments on from when you first graduated. So you might have much lower payments than you would see if you re-showed your income right now. So you want to think carefully if you're about to do something that forces you to recertify your income. So for example, if you're going to consolidate, or if you're going to change repayment plans, if you're going to do any of those things that's going to force you to re-show your income. So you want to think carefully about that, especially if your new recertification date is pushed out to early 2025. You might have a long time to ride that low payment until you need to re-show your income. And then a couple more here. July 1st of 2024 is sort of our last important date. And it's important for a couple of reasons. Number one is that all features of the Save plan are going to be live. The second reason it's important is that is when you are no longer eligible to get onto Pay As You Earn. And so this leads to some important decisions to make leading up to July 1st of 2024 if you're qualifying for Pay As You Earn, especially if you started taking loans after the fall of 2007 and before 2014, right? So you're in that window where you're eligible for Pay As You Earn and not eligible for this new version of the IBR plan. And it's important because Pay As You Earn is going to have a 20-year route to forgiveness versus the Save plan, which is going to have a 25-year route to forgiveness. So if you're expecting your income to rise at a reasonable rate over your career, those extra 5 years can make a pretty substantial difference. A Save plan is likely to have a lower payment, and it also waives any unpaid interest, right? None of that will accrue under Save. So there are important differences between the two, but one of the most important is going to be that 20-year timeline to forgiveness versus the 25. So between now and July 1st, really June of 2024, you want to run the math and say, what is the best decision long-term if you're going towards forgiveness? Is it Pay As You Earn or is it the Save plan if that's the route you go? So these are some examples of where the Save plan is great, but it's not the right decision for everybody. You just need to look at all of your options and evaluate that carefully and see what the best decision is for you. Okay, so now we've talked about some important updates that have come up. We've also talked about important deadlines to think about as an optometrist. And now let's talk about how to tackle student debts. Let's talk about what approaches you should be considering as you're going to be tackling your student loans, and what are the factors that you need to think about when making that decision. The question I get a lot is, should I refinance my debt or should I use an income-driven repayment plan? And I'm just going to call those IDR plans, right? So anytime you hear IDR, that's income-driven repayment plans. And asking whether you should refinance or use an IDR plan, I think is the wrong question to start with. You shouldn't start with refinancing. The question you should start with is, what is the right approach in general that you need to take to tackle your student loans? And to me, there are three general approaches that you should consider when tackling your student debt. I'm going to talk about each of them and we'll talk about the factors to consider, right? So the first one you want to consider is going to be paying your loans off down to zero. And in this case, you're planning to pay them all back and you're sort of treating it like any other debt. You're trying to pay them off as aggressively as you reasonably can, trying to limit the total amount of interest that you're paying over the whole term of the debt. And you're going to include this debt now in any debt avalanches or snowballs you're working on along with other debts you have, but you're really going to approach this like tackling any other debt. And sometimes, maybe often, but definitely not always, it can make sense to refinance your debt. Now, remember, refinancing is not the end goal of itself here, right? Refinancing your debt is simply a tool that you can use when you are trying to pay your debt down to zero. It isn't the goal in and of itself. It's a tool that you can use. And I always preach caution when talking about refinancing decisions. You don't need to refinance your debt if you're trying to pay it down to zero. It's just a tool that you can use. And the purpose of refinancing out of the federal student loan system to a private refinancer or private lender is simply to lower your interest rate. It will hopefully lower the total cost of the debt or shrink the amount of time that you're paying the debt down or lower your required payments, right? So you're trying to get a more favorable interest rate than what you're currently seeing in the federal student loan program. However, it's a one-way street. Once you refinance out of the federal student loan system, you cannot re-enter it, right? This is a one-way road here. The exception here is COVID, in that in this bizarre world of the COVID pause, if you refinance during the COVID freeze, you actually had a chance at successfully requesting a refund of that refinance, essentially reversing that and re-entering that federal student loan system. So that is an exception that still amazes me that was possible, but that was something that was actually possible. But now that we're past the deadline to do that, it's a one-way street, right? So once you exit the federal loan system, you cannot re-enter it. So you need to be certain you want to go this direction of paying your debt down to zero. You need to make sure that you have the cash flow to do it, and you have other basic foundational financial planning stuff tackled or handled. Your emergency fund, basic insurance policies like life insurance, disability insurance, some of those basic financial risk management topics need to be taken care of as well. And in my opinion, you want to make sure that the interest rate is material, right? It's not just a 0.25% or 0.5% difference. Like, it is a 1 to 2% difference. It's going to have a material impact on the math there. And I guess every one of you needs to decide. I mean, you really need to decide how much of a difference is worth it, because you do need to think about what you're giving up if you're doing that. You're giving up all of the protections and flexibilities of the federal student loan system, as well as all of the potential positive changes that can happen, as many optometrists have seen, having refinanced and now working at these employers like Kaiser and others are now eligible for PSLF, and they don't have federal student loans. So everyone has to make the best decision you can with the information you have in this moment. But you just have to realize when you're refinancing, that's a one-way road, and you're giving up those protections and flexibilities when you make that decision. So it has to be, the interest rate has to be something with some meat on it, right? It can't be just the very slightest amount there. If you do refinance, a couple things to consider are, number one is you want to review that promissory note. So how is the lender going to treat that loan at your death or at your disability? Will they discharge it, or will it be due? Or is that something you need to plan for with insurance, disability insurance, life insurance? If you have a cosigner, what happens to that cosigner, or what happens to that debt if something happens to the cosigner? Can you release the cosigner without refinancing again? Are there other opportunities for forbearance within that private loan? So take a look at the terms of the debt in that promissory note and compare that to what you'll find in your federal loans. And some servicers are going to be more favorable and will be a lot closer to federal loans, and others will not. So just take a look at those terms and making sure you understand what the terms are of that debt. The second thing to consider is what's called a refinancing ladder. And what that is that when you refinance, you don't refinance to the shortest term possible. In fact, what you would do in this case is you would refinance to a longer term refinance loan, maybe 15, 20, 25 years, whatever that may be. And the reason for that is because if you're refinancing for a longer term loan, you are lowering your required minimum payments. Now, you're probably going to pick up a higher interest rate on a longer term refinance loan than you would with a shorter term. But what you're getting in return is additional flexibility in your cash flow. Even though you have a lower minimum required payment, you still continue to pay a higher payment. You make additional payments to the principal that you would have made under a shorter repayment plan, right? So you have a lower required payment, but you're still making that higher monthly payment and tackling that principal amount. And then as that principal balance gets smaller and smaller, you then refinance again into a shorter term loan, picking up what's hopefully a lower interest rate, although I guess there's no guarantee of that, but hopefully picking up a lower interest rate. And what you'll often find is that you can refinance and pick up an upfront bonus as well. For example, if you go through like Student Loan Planner or ODs on Finance, any of these groups that have affiliations with these private lenders, a lot of times you can go through them and get upfront bonuses and put that towards your debt as well. So you continue to pay that higher amount each month. And then as your balance, your principal balance gets smaller and smaller. You just refinance into a smaller amount and into a smaller amount. And once you get to a pretty small balance, you can even decide whether you want to use a fixed rate or an adjustable rate, because that debt's going to be tackled within a pretty short period of time. So that's something to consider as well, whether that makes sense for your situation. You gain at least a little bit of flexibility, at least as much as you can, with private student loan lenders. So that's paying your debt down to zero, treating it really basically like any other debt. The second general route to take is going for forgiveness. And that can be public service loan forgiveness or going for long-term taxable forgiveness. And when you're going for forgiveness, you need to take everything you've ever learned about managing debt and throw it out the window, right? Because going for forgiveness is unlike any other debt management technique you know of. When you're going for forgiveness, the goal is to pay as little into the debt as possible so that you can get as much of that debt forgiven as possible, right? Again, I want to say your goal, your purpose is to pay as little into the debt as you possibly can over that time period and get as much of that debt forgiven as you possibly can. And this is treated more like, you need to think of this debt more like a tax instead of debt that you're actually trying to pay down. Because you're trying to lower your taxable gross income because you're using income-driven plans in order to do this so that you can lower your annual payment, so that you can pay as little into the debt as you can. And that's hard for a lot of people to grasp. A lot of people feel this, sometimes a responsibility. Other times it's stressful to see your loan balance not making any progress, but that's a feature, not a bug, if you're going this direction. And the first type of forgiveness to consider is if you are working for a nonprofit, and that's public service loan forgiveness. And this is tax-free forgiveness of the remaining balance, including principal and accrued interest, once you reach the required amount of payments. So how do you get PSLF, public service loan forgiveness? You have to make 120 payments, so 10 years of payments on direct student loans. So FFEL loans wouldn't qualify on direct student loans using an income-driven repayment plan. Although technically the 10-year standard plan would also qualify, but it doesn't help here, right? You're going to pay it down in 10 years anyways. So using an income-driven repayment plan while working at least an average of 30 hours per week or more for a qualified nonprofit or government employer, right? So again, that's 10 years of payments on direct loans using an income-driven repayment plan while working what's considered full-time, so an average of 30 hours per week for a qualified nonprofit or government employer. And there's been a number of adjustments to the PSLF program starting July 1st. So I'm going to link to a page about that in the show notes. One of the biggest ones, again, was that ability for Kaiser doctors in California and in other states, similar states, now being eligible for the PSLF program. So that is a tax-free forgiveness after 10 years. The second type of forgiveness is simply a long-term taxable forgiveness over 20 or 25 years. And this is where you will receive forgiveness of your principal and interest balance after making 20 years of payments or 25 years of payments of qualifying payments on an income-driven repayment plan or the standard 10-year payment plan. And it's 20 or 25 years depending on the income-driven plan you're using. If you're on the new version of IBR or on pay-as-you-earn, that's 20 years. And if you're on old income-based repayment, or really now it's probably going to be the SAVE plan, that's 25 years if you have any graduate debt. So that's the timeline you're expecting of once you've made that many payments, your balance, including accrued interest, is forgiven. However, the big difference between PSLF and this long-term forgiveness is that according to current tax laws on how forgiven debt is handled, that forgiven amount is going to be taxable income in the year you do it. So it's going to be added onto your tax return, and it's going to be taxed at whatever your marginal tax rates would be in that year that it's forgiven. So the tax is a part when you're evaluating these plans. The tax is a part of the total cost that you need to consider when going for forgiveness, but it can be planned for as part of going for forgiveness and part of paying the payments. You also want to invest on the side in a taxable brokerage account, so a non-retirement account, to build up dollars for this. And you have potentially 20 to 25 years in order to start to build up that balance and plan for this, assuming that laws don't change and it's still taxable when that time comes. So those are your two forgiveness options. And I do want to say, like, these are not last resort strategies. This is especially going for a long-term taxable forgiveness. If you're working for a for-profit employer, this is a perfectly legitimate strategy to tackling your student debt for those that it makes sense. It doesn't make sense for everybody, but for those that it does make sense, this is a perfectly legitimate strategy. Again, what's important is thinking of this like a tax. The more you can drive down your taxable gross income, the better it is, because you're lowering your payments, your quote unquote tax, and you are getting as much of that debt forgiven as you can. And that means using pre-tax benefits like traditional or pre-tax retirement accounts. You would favor those accounts over Roth accounts because of that. The effective tax rate you're saving is probably going to be worth it to use those accounts. HSAs, if you're covered by an HSA eligible high deductible health plan, and other pre-tax employee benefits, those all come to play when you're trying to lower your taxable gross income. And going for forgiveness sort of opens up the doors to other planning opportunities that we'll talk about a little bit later, but it's going to be impacted by things like family size and how you decide to file your taxes, whether married filing jointly or married filing separate, whether you live in a community property state, how you decide to recertify your income, what type of income. Is it your adjusted gross income on your tax return? Is it your pay stubs? That all comes into play. So there's a whole door of planning that comes with this in order to adjust the math here. And there are some things that cause hesitation for using these plans. Number one is there's often just a mistrust of government, and there's not much I can say here to change your mind on that. Some other things that come up that cause some hesitation is that oftentimes you're going to see, or you may see, a lack of progress on student loan balance, or sometimes an increase if that accrued interest is happening. But what I'll say to that is a feature of this, not a bug, because remember, your only goal, say it with me, is to pay as little into the debt as possible, so that as much of it as forgiven as possible. So that's not necessarily a concern, in that it's a feature of this and not a bug. There's sometimes a concern about future changes in income-driven repayment plans or this federal student loan system. And this is legitimate, right? Just as the Biden administration changed or restricted access to pay-as-you-earn or new income-based repayment and created SAVE through executive action, a future administration can make changes as well. Although the income-based repayment plan is in statute, so it's in law, so that would take an act of Congress, but a future government, a future administration can make adjustments to these things. And especially when you are thinking long-term over 20 to 25 years, you have to keep that in mind. So there is some uncertainty there, but this long-term uncertainty that you're thinking about here is the same thing for any long-term financial decision you make. You think about whether to use a Roth account versus a traditional type account, a pre-tax account. You're making a decision. If you use a Roth type retirement account, you're making a decision to tax those dollars today and to allow it to grow tax-free into the future. You are making a bet that future tax rates that money would be withdrawn on are not going to be materially lower than what you're getting taxed at now, or that Congress doesn't change the laws to impact Roth IRA or Roth 401k balances in the future different than what we're seeing right now. You still have that same type of legislative uncertainty in almost any long-term type financial decision that you do in these student loan decisions. And all we can do is make the best decision that you can now with the information that you have, and leave yourself room, give yourself grace to make adjustments down the road, understanding that things can change. And it can also change for the better. I don't want to neglect that as well. We've seen over the last couple of years, student loan policy has adjusted for the benefit of borrowers. And that very well could happen in the future as well. This isn't only about downside or negative impacts. You can see positive impacts as well. We simply don't know. And to a point, we have to admit we are only speculating. So make the best decision you can now, giving yourself room, flexibility to adjust down the road. One way to sort of hedge against that is investing and building assets, especially if you're building assets like we talked about, preparing for that tax and building in a taxable investment account. This is a great way to sort of help to hedge against that future uncertainty because you're building your net worth. You have assets that in the worst case scenario, you could use that and put towards your debt and pay that down in the future. So one other thing that comes up is that you do have to, as you plan for this, project out the next 20 to 25 years of your life. And there's a lot of uncertainty around that, especially if you're trying to make this decision right out of graduation. So do the best you can with the assumptions you can. Test different assumptions, different family sizes, marriage, different income levels, test assumptions and try to arrive at a decision that makes the most sense for you. Thirdly, you can take a hybrid approach where you can use income-driven repayment plans in the short term strategically, temporarily as needed for cash flow or for other purposes, and then switch gears later on and pay your loans more aggressively down the road. And this is made much more interesting with the SAVE plan because under the SAVE plan, any unpaid interest is waived. And so you don't, if you start on the SAVE plan, you ride, low payment years in order to build up a cash reserve or to save for practice ownership or whatever it may be, you're not penalized with accruing interest while on the SAVE plan. You can switch directions down the road and you'll still only be left with that principal balance. And if you do change directions, you may even have a nice cash balance in order to put towards that debt. So this is something you might think about, using an income-driven repayment plan temporarily when you are needing to build up a cash reserve or you have certain life goals such as buying a house or maybe even especially preparing for practice ownership or in the early years of business ownership. Using these payment plans as sort of a stepping stone, I think is a great example of where that can make sense. And then as cash flow gets more predictable or stronger, you can switch directions and tackle that more aggressively down the road. So those are the three general approaches to consider, right? You're paying it down to zero, you're going to some type of forgiveness, or you're taking some sort of hybrid approach. What are the factors to consider when making that decision? How do you know which payment plan to use? Well, here are some things to consider as you make that decision. Number one, and really importantly, the first factor to consider is your level of federal student loans versus your income. So how much student debt do you have in relative to the amount of income that you're earning or expected to earn over the next several years of your career? And why is this important? Well, remember that your income-driven repayment plans the payments are based on your income. And if your income is increasing to a certain point, you're simply not going to benefit for forgiveness. Either the total amount you're paying into the debt means that the cost is high enough to where you would have been better off just paying it down anyways, or perhaps your income is too high to where you actually just end up paying the debt down and don't benefit from forgiveness. So the amount of federal loans you have, the level of federal debt you have versus your income is a really important factor there. As a general rule of thumb, what I think is that once your federal loan balance is 1.5 times or more than your current income or expected income, I think that's the point where you really should carefully consider and look at the math whether forgiveness under an IDR plan makes sense. So for example, if you have an income of $150,000 and your student loan balance is $225,000, like that might be the threshold where you really should look at the math and evaluate all your options and evaluate carefully whether that makes sense for you. And that doesn't mean it will make sense for you. That doesn't mean it's a slam dunk, but that's where I feel like you should really carefully evaluate the math. And if you're below that, if your income is much closer to, or you're expecting it in the near future to get much closer to your student loan balance, then you're probably going to be better off over the long term paying it down altogether. So that's something to consider, your debt to income ratio with your federal student loans relative to your income. Private student loans don't impact this at all. They're not impacted by any of the IDR plans. It's just your federal debt. Now, this is an important factor, but it's certainly not the only factor. The next thing to consider is changes in your family size. Now, there are several ways where marriage and kids can impact the math of student loans under income-driven repayment plans. For example, Marriage increases your family size, which increases the poverty line amount that's subtracted from your student loans, which can lower your income-driven repayment plan payment, right? That's going to lower your calculated payment. However, if your spouse's income, that will increase your income-driven plan if you're filing taxes married, filing joint. If your spouse has federal loans, that can positively or negatively impact your IDR payment, depending on the size of loans and incomes between the two of you. It's getting more complicated, isn't it? If you're married, it may be beneficial, highlight and underscore may be beneficial, to file taxes separately because you can exclude your spouse's income from that loan calculation. However, it also comes with tax planning considerations. Filing taxes separately impacts a whole list of things. So this is where tax projections need to come into play and the tax impacts need to be weighed against the student loan benefits. But that may be beneficial. Filing taxes separately in a community property state makes for even more interesting planning opportunities because in a community property state like California, when you look at your federal tax return, it's going to essentially cut your household community property income in half on your tax return. So you have additional decisions on when you are recertifying your income, whether you're using your adjusted gross income on the tax return, whether you're using that split in half community property income on the tax return, or whether you're using your pay stubs to show as alternative documentation of income. So community property states introduce a whole other planning opportunity. And then lastly, having more kids can positively impact the math and lower your IDR payments because it increases that family size again for the poverty line amount. So if you just want to do some really advanced student loan planning and some advanced tax planning, just have more kids. Jokes aside, all of these changes in your family size can impact this math in some very interesting and important ways. So trying to project that out can be difficult, especially if you're recently graduated and not married and trying to think about the future. But those changes are important. So your family size or changes in your family size are another really important factor there. Career decisions are important. Are you going to be steadily employed as an associate doctor, or are you planning to go into practice or business ownership? Are you going to work for a nonprofit, or are you going to work for a for-profit for most of your career? What is the trajectory of your income growth? Is there a lot of uncertainty what you want to do in terms of your career choices? That's going to impact what you want to do here, because if you are wanting to go into practice ownership, or if you have a lot of uncertainty about what you want to do, I probably wouldn't recommend refinancing. I'd probably would want you to stay in that federal student loan system and hang on to those flexibilities until you can make a better decision there. If you're going for a nonprofit and you're going to be working there for 10 years, well, PSLF is now an option for you. If your income is expected to rise substantially in the near future, well, that's going to impact the math there. So your career decisions comes into play. Your cash flow and family needs are very important. What are your cash flow and family needs at this time? The best long-term course of action is one thing, but what do you need right now? Have you recently started a business or soon will start a business and need that flexibility in your cash flow? Do you need more cash flow in order to build up an emergency fund or build up some funds to purchase a house and a place to live because you need a new place to live because your family's growing? Don't make student loan decisions in a vacuum. What else is going on in your life and what are your priorities and how do your student loan decisions fit into that? Right? You have to live life. You can't let student loans drive every life and career decision that you have. Make your decisions around what's best for your family and your career and what's going to give you the best opportunity of growing your net worth over time, and then fit in those student loan decisions around that. And then lastly, your values and feelings around debt. You have to incorporate how you feel around debt in general or in particular student loan debt when making these decisions. Your feelings and values come into play in debt decisions, maybe like in no other financial decision. It's a highly charged topic. And so there are some borrowers, some optometrists that regardless of the math, simply prefer to take control over what happens with their student loans and pay it down to zero and know that it's going to be paid off within a certain timeline. And they're going to work the extra hours. They're going to take extra shifts on the weekends. They're going to take side hustles. They're going to live frugally, whatever they want to do in order to make that happen. So you have to just generally think about, how do you feel? What are your values around debt? And how do you want to tackle this debt? You may not want student loans in your life for 20 or 25 years. You may want to tackle them sooner. And if that's what you want to do and you have the finances to back up that decision, then that's the decision you have to make. Others are indifferent and simply want to look at the probable math and make a decision based on that. There's always a balance between what's likely mathematically optimal versus what's values and psychologically optimal. You have to figure out where you fit within that balance there on that spectrum. What didn't I say? Well, what I didn't say was that you should consider what everyone else says you should do about your student loans. There are a lot of opinions out there about how to handle student debt. There are a lot of opinions about the student loan program in general. And I think you should ignore all of that. Sure, you should listen to the opinions of your peers. You should listen to guidance from people you trust. But ultimately, you have to look at your own circumstances, look at the math of the decisions in front of you, and make the best decision for you and your family. So hopefully that was helpful. If you have any questions, reach out to me, Evon, E-V-O-N, at optometrywealth.com. There's probably some time before at least mid to late October if you'd like to schedule a student loan consultation. And this is a part of my ongoing services for clients. So if this is something you want to think about, if you're looking for a financial advisor that includes your student loan decisions as an optometrist in the financial planning process, reach out to me. Feel free to schedule a no commitment introductory call. We can talk about whatever's on your mind financially and how I'm helping other optometrists like you manage student loan decisions, as well as and in light of all the other decisions in your life. And don't forget to check out the show notes for all of the resources and links mentioned in this episode. If you have any questions on student debt, or if you have any topics for future episodes, please feel free to reach out. If you've enjoyed the podcast, would really appreciate it if you can leave a review on whatever platform you're using. Those reviews are super helpful to me in order to improve this podcast and make it a better and better resource for you, as well as to get this podcast in the hands of more of your peers. So please leave a review. Those are super helpful. Hopefully this is the last episode about student loans for a while. And what I mean by that is that hopefully we don't have any major changes. So we're going to talk about a lot of other topics coming up. I'm going to have a series, I think, on risk management and some things you should think about on managing financial risks. So hopefully we will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.